Okay, well, for all of us that are investing in the paper side of business, in notes, we're always interested in a mortgage market outlook, what in particular now is likely to happen with interest rates, for example. And so I wanted to let you know that our team was at the AmeriHome Advisory Council meeting last week in California, and one of the chief speakers was Mike Fratantoni, chief economist at the Mortgage Bankers Association. So, of course, if we take a look at online, what is the mortgage market outlook? We can kind of click in here on Google Mortgage Market Outlook 2022, and we'll see that one of the first results that's not an ad would be a Forbes article, which is quoting this person, MBA economists, none other than Mike. And so if we click through that, we see that we're inside of Forbes Advisor, and we're going to find out, that costs have taken a toll, lowest level of mortgage applications in the past 22 years. This is all what we can find online. Now we're going to supplement that with live information directly from Mike. But here again, we see that gross domestic product has declined for 2 consecutive quarters, which some economists say indicates a recession. I think that is the definition of a recession, is that gross domestic product, GDP, declines for 2 consecutive quarters. But it's interesting that there can be a discussion about that, and there is apparently some point of view that can say, well, maybe it wasn't a recession this time. Things that make you go, huh? So MBA has not included a recession in their baseline forecast, but they estimate, according to this article, a roughly 50% chance of entering into a mild recession over the next 12 months. Things that make you go, huh? And then the amount of existing home sales drop that we're all aware of, median prices and so forth. They don't see home prices falling in the near future. They're looking at a more orderly price increase for 22 compared to 2021. Okay, so let's now take a look at the kind of the data that underlies some of this, and you can see that although we started the first 3 quarters of 2022, that's that black line, with mortgage, what we're looking at is purchase mortgage applications index. Okay, non-seasonally adjusted, count of loans. We can see that we started off pretty much okay, and then we're dipping down now below any of the last 4 years. So the trend seems to be that purchase mortgage applications are a bit below what we would have seen in the last 4 years. But the real story is the total loan applications. So the total loan applications can be seen on this graph, and this is worth a little bit of study. So what you can see is that in 20 and 21, these yellow are the refis, and green is the purchases. So you can see in 20 and 21 that the refis were, let's say, outsize beyond what the normal trend would be, and then correcting to be below what the normal trend would be as a ratio to the purchases. So you can see those purchases are drifting down, as we saw in the previous graph, drifting down in 2022, and are expected to drift back up again according to MBA numbers. But what's really driving the total way down, see how this total, this gray line, drops way down? Of course, way down, it's more or less on par with 2019. But what's driving that down is these refis being way under as compared to 20 and 21, where they were way over. See, more or less, these are more or less like 2002 and 2003 when they were way over. And then, this way under is something that we saw before in 2017 and 2018. So that's what's driving this total down, is the refis. So now, let's return to that question that I signaled. GDP has gone negative for 2 consecutive quarters. Are we now in a recession? Well, it should be by definition we're in a recession. What does Mike say? He said that he thinks it's kind of tough to categorize this one as a recession. Interesting. Because the job market is strong as it's ever been in 50 years. 400,000 job growth in the first 6 months of 2022. Consumers are spending. Businesses are expanding. So that's why Mike, chief economist at MBA, says that although by operational definition, that 2 consecutive quarters of GDP decline is a recession, it's kind of not a normal scenario for what you would call a recession. So here it is, that monthly payroll growth in thousands of jobs and the unemployment rate. So here we are in January, February, March, April, May, June, July, August. You can see those jobs pretty. Of course, they're growing against this very easy baseline, is it not? But still, they're growing. And more importantly, that green line, that 3.7% unemployment rate is, is it upticking a little bit? I don't know, but it's overall in line with this number here and, look okay. So this is what is driving Mike to say, okay, I'm not sure we can yet call this a recession. So then he goes on to say, or went on to say last week, that's not to downplay the risk that we're in right now. And especially he called out the Fed's rapid increase in rates, which is a point that we'll return to in a moment. So interest rates have been up to 6% at times earlier in the year. Where do we see them going for the rest of the year? We'd all like to know that since we invest in notes, is it not? So here's a look at the refinance index and the 30-year mortgage rate. And as you can see, these two indices tend to drive each other in the opposite direction. So when we see a high 30-year rate, we see a low refinance rate, which is what we see here. Here's where we saw that big spike in refinances that you saw on the previous graph. And you can see these are mirror images of each other, is it not? So naturally, as that 30-year fixed rate is driving up towards, as you can see, it did get up towards 6%, the refinance rate goes down. Now, what Mike says is that he sees this kind of settling down in the 5% range, which frankly is, it's a little high, but it's not shocking. If it were to settle in at the 5% range, I wouldn't be overly concerned on the basis of that one data point. So mortgage rates have likely peaked, says Mike, and will likely drift down from where they were. They won't get back to 3, probably be around 5 for the next couple of years. This is according to Mike, chief economist at MBA. So you ask yourself, why 5%? Why not more? Why not less? Why 5? So he thinks 5 because on the one hand, there are worries of recession. That is a factor that pulls rates down, when the Fed is pulling these controls. And on the other hand, inflation numbers are coming in very high. So 2.25 is the Fed funds target now, and that's neutral, according to the MBA, 2.25 federal funds rate. So here we are with that high inflation that he was referring to. You can see all items up. This is the light blue or turquoise line at 8.5%. Some people think it might be more. Certainly food is more, even according to this index, the inflation index at 10.9. But let's accept 8.5 as the number. You can see that based upon this method of measuring over a timeline that covers from 2008 to the present, it is certainly very high in historical terms for that portion of the timeline. So indeed, that is a concern, and indeed that is what is driving the Fed controlling by adjusting. So, Fed Chairman Jerome Powell says that the next hike is likely to be smaller, maybe 50 basis points, or as little as 25. But we've been surprised by this guy before, have we not? Earlier this year. So the June FOMC meeting was a big surprise, might call that out. We went into that meeting with an ironclad assurance that they would raise by 50 basis points. And then instead, there was a last-minute announcement they would shock the market and raise by 75 basis points. So that's what happened. It was not a normal way for the Fed to signal and then act. And but the MBA is thinking that the Fed funds rate will probably be around 3% by the end of this year. That June announcement was a very different operating procedure for the Fed. And Mike thinks that they're going to be more cautious through the remainder of this hiking cycle for all the reasons that we discussed. So here we are, a rate history and forecast. So here we are with the Fed funds rate, the blue, and then the 30-year fixed mortgage rate reacting to that. Here we see in 2022 kind of on a blended basis coming in at around this 5% that we spoke of a moment ago. That's blended across the whole year. And then maybe drifting down. Who knows? This is a forecast for the future, but this is what we're seeing for the end of this year, maybe around 5% at the end of the year. Okay, so I thought that would be interesting to share with you. I hope you enjoyed that, and we'll talk to you later. Bye for now.